What is going on, Hot Take Nation? It is DRW here. You probably see in the video and you hear a hand clap. We do that for producer Glenn, who's in the background, making sure that all the video and audio are synced so that our fans on YouTube can get this beautiful basement every single time on the show. For those listening to the audio, we got the microphone set up. And today we take a total break from what we talk about with commercial destruction, the death of the economy, and all things upstream E&P. And we talk midstream. So we have You-won Themaaaaaaat. And the reason that we went through a whole name pronunciation is because I just recently went to DRW because it's so much easier than David Ramsden Wood. And so when people on Twitter want to troll and curse me, I don't want them to have to use so many characters on my name. I just want them to use 3 and then everyone knows who they're talking about. So that's the origin of my stage name. Now, You-won, you tell me the origins of your name, because that is a very American name, if you ask me.
Well, thanks first and foremost for having me, DRW. This is a pleasure to talk to you. And my name is ridiculous. It's a Dutch last name. My last name is Johan Themaat. 4 words. Complete disaster, even in the Netherlands or South Africa, where I'm from. So, I mean, the best I could do is shorten it to Themaat over here in the States, but that is still a mouthful, I think, for the English speaker. My first name, Johan, is as common as John. It's just a Germanic version, I guess, of John is Johan. So I'm trying to deal with a long name that my dad gave me that I'm proud of, but that's a little bit long. But Johan Themaat works, and you did very well with that.
Well, so I find names are fascinating for a lot of reasons, right? Because one of the things that always, and I think about it as a benefit, right? Was my name was David Ramsden Wood. First of all, there weren't a lot of Ramsden Woods, and if you remembered it, if you saw it again, you would always be like, I know that guy. And so for me, from a name recognition, not that that's super important in your career, but just for long-term recognition of what you were doing, the name has been good. Also, people at work for the last 15 years called me DRW. When I was up at Fort Berthold with Enerplus, my Indian name was David 3 Names, which I always really appreciated as well. So you're with Black Canyon Midstream, and I want you to start, because we don't talk a lot about midstream. We're going to go into all the topics today. I would love for you to start with a little bit about what is Black Canyon Midstream, what are you trying to do, and how has 2020 and the latter part of 2019 been for the business, you specifically, but also midstream overall?
Yeah, so Black Canyon Midstream is a gathering company, right? Oil, gas, and water. Our unique take on a boring old business is that we believe fundamentally, and the company's set up this way, that doing oil, gas, and water together is better than doing them separate. So to put it simply, if you open up the ground, let's put 3 pipes at least in the ground at the same time. Or if you're negotiating a right-of-way, let's do 3 at the same time. If you're paying somebody to manage something or G&A, let's do it at the same time. So we believe the industry is going that way. Multi-commodity pipe, you see the more advanced operators doing it already. They've been doing it for a long time. And we're trying to bring that same systems to the smaller and medium guys. Now, we will do a single commodity system. We will do a water system, a gas system, or a crude system. But in the back of our mind, we are always thinking about how to be as efficient as possible. And
what about the electrical? Did you do the electric corridor as well? And I know one of the things that was key to our development plan was we always talked about oil, water, gas, the same ditch, open at once, but also lay down the electrical. And so that our development plans always were go to a pad, drill all the wells you're ever going to drill. Don't wrongly space. And by that, I mean drill too tight, drill your wells, frack your wells, do the whole stimulated reservoir volume, take it all away, and never go back. Do you see a lot of guys moving to that, and are you using the electric corridor as part of that?
We haven't had a lot of demand on the electricity side. Certainly, it's part of what we do, right? Open up the ground, do as much as you can in one shot. On the electricity side, we're having more conversations about related to gas flaring and generating electricity and using electricity on pad, and even doing solar and other kind of electricity applications as part of the midstream system. Certainly for ourselves, we believe we don't need to emit anything in terms of emissions, that we don't have to. So we're thinking about it more and more, but we haven't had a lot of demand on electricity in the same range. I think it's certainly something we think about when we open up the ground.
It's Go ahead. Sorry.
No, then on this is the holy grail on our side is the multi-phase gathering, right? We've seen selectively onshore people doing it. That certainly is the model offshore, but certainly do one pipe to a central gathering facility to the extent you can. So that's not even separating at the wellhead, right? There's lots of complications when you try to go that direction, but it is certainly something we are looking at, exploring further. And we think this is the way that the business is going. So separating at the central gathering point, try to just do as much as you can with a single pipe.
Yeah.
But not much going on practically in the field on that field today, but certainly something we're looking at for the future.
Yeah, so one of the questions I was going to ask is we were talking about solar and wind, which I love that you touched on it. I hear some companies, and I think it makes sense in places where you have huge electric demand for yourself to, if you have a large footprint and you already have operators and you're already going to the sites all the time, to be able to try and incorporate maybe some of these solar farms and wind farms. But in terms of working with the utilities, one of the things I've always seen over my career is the utility companies don't really want your energy. They want they want big deals and not intermittent. And certainly with gas, when you talk about electric generation instead of flaring, day one of the well is the most that well will ever produce in gas. And if you do what our philosophy was, which is, all wells on the pad, 4 or 6 wells on at the same time, all the gas on at the same time in a pipeline, your electric generation would always go down, but you have to build this massive infrastructure, and it takes so long to get electric infrastructure versus the midstream. Do you think that electric companies will get better and more efficient like midstream companies are at laying pipe, or what do you think the limits are on that?
I think you've got the utility issue, right? The classic, that's why people aren't as responsive as certainly the medium and more aggressive oil and gas companies. We tend to move very quickly on the midstream side as well. And then when you talk to a utility where that's just not the mindset, right? Long-term planning processes, long-term budgets, and you say, hey, I need an electricity line in 3 months. It's just tough culturally for some of them to do it.
Absolutely.
The conversation around solar electricity is more early stage, right? People are scratching their heads about what to do with this flaring regulations that people think is coming down the pipeline, and how do we deal with that? And can we use it for on-site electricity? And then they see emissions regulations coming down the pipeline, and they go, oh yeah, can we do something with, instead of running gas generation, can we do solar? And the practicality is it's just difficult. It is really difficult with what you just said, the big spikes in gas production, to put that on electricity when your electricity generation curve is going to follow the same curve, right? So you're going to generate a hell of a lot of electricity that you don't need if you go that way. So it's difficult conversations we're having with not honestly a lot of luck.
Yeah.
Quite frankly.
No, not surprising. It's
problem.
It's very technically complex, and I think that
Yep.
certainly in California, one of the challenges is policy, and that the demand isn't always in the right place, and they don't allow you to move and load level and stuff. But I think people forget when you plug your toaster in, the complexity of getting that amount of electricity to your house for that to work always is absolutely incredible. And if you travel the world, there's rolling brownouts in most parts of the world because their electrical infrastructure is not built anywhere near as good as ours, and ours is so aged that it's really one of the concerns that are coming. But we digress a little into electric. Let's talk about where Black Canyon Midstream came from, what the reason that you started the company was. You are the CEO there. And curious about, as you built the team and as you started the company, what was the need you were trying to fill in the market, and how do you see COVID changing that?
Yeah, so it's a little bit about where I ended up, luck of the draw, I think, and in terms of ending up in midstream. I am not an upstream geologist or a mineral scientist or anything like that. So I ended up in the cash flow side of the oil and gas industry. So service companies and midstream companies, just because that's what I knew. So in terms of I have a financial background coming out of the investment banking side of things, and I just loved midstream. I think it's a long-term necessary value-added part of the chain. And that's where I ended up. And in terms of the whole midstream space, I thought, where can I add the most value as a smaller player in the field, and I saw the biggest need on the gathering side. It is certainly not as big dollar and earth-shattering as some of the interstate pipelines, like everything going on with DAPL and Rockies Express and all these major pipelines that I worked on. But I do feel, in terms of serving my client, which is the operator in the end, there is a lot of complexity in the gathering side, where you're actually hooking up wells, and those wells don't always tend to behave, and you're dealing with smaller landowners, a lot of right-of-way. So in terms of looking at a problem that is difficult to solve, where I found I could add some value versus just be a financial provider, I felt gathering is the place. And as soon as I started looking at gathering, I realized, listen, there's a better way of doing this than having a gas company, a water company, and a crude company. Let's try and do wherever we can the three together, one touch point to the producer. And I think that idea has been sold in the industry. I think it's just now up to the midstream companies and the producers to work together more to make it happen practically. Because so that's how I ended up where I am. And I started my first business in 2014 from a situation where I was told, listen, you're going to move to Tulsa or you're not going to have a job. And then I went, all right, what am I doing? And I convinced myself that starting my own company is a good idea. And that decision, I'm still questioning. Certainly my wife sometimes questions
that's
but
a fact.
it's been an honor and a great experience.
That is a fact. It is amazing that, like, the entrepreneurial journey is always a lot more fun looking at it in the rearview mirror. And I tell this story all the time to my friends. So most people know I worked at Anadarko until 2009. And when I left to go do the smaller thing, so many times between 2009 and 2018, when we ultimately sold One Energy, I was saying, like, I would be so happy at Anadarko, and like just working with the big sandbox and like the budget and planning. And I would go into this sort of whimsical sort of thought process with a lot of my ex-colleagues at Anadarko, and they would start looking at me like I was a little bit crazy. And they said, David, you do remember how you felt about a big company at the time? I'm like, no, I don't. I remember how great it was. So the grass is always greener until you have success, I guess. Now, when you look at your peer companies in terms of solving the small to mid-size midstream solution for operator producers, going into large haul pipeline, which we'll come back to, but how has COVID impacted your business? Are you seeing a lot of discussions around consolidation? Is it hunkered down? Are you seeing more traction from producer operators who are looking at all three streams as like a revenue source? Or what has been the change as you've seen it?
Well, I'll tell you, honestly, it just screeched to a halt. Multi-commodity works based on greenfield. When you're building something new, so when you open up the ground, you can plan a new system around all three your streams and where they're going to go. And there is just very limited need today for new pipeline. New pipeline goes with new drilling, goes with new areas of development, and new projects have screeched to a halt, I think, across the industry, not just for us, for everything. But the other side of the business is we're also looking to acquire systems, single commodity systems, and then with a long-term vision of making those multi-commodity. That business is really interesting at the moment, the acquisitions. I think it's still difficult. We have a couple of great projects underway on the acquisition side that's looking very promising, but really until earlier this month, maybe late last month, that has also screeched to a halt, where people were a lot of these systems we're looking to acquire are sitting with producers. So producers were not yet ready to sell them. The whole industry has been in such flux that it's really difficult to value anything for next year, let alone a 15-year horizon that we're taking on midstream assets. So because of that valuation difficulty, producers thought the assets was worth X. Midstream investors are thinking the assets are worth Y, and we just couldn't connect. It's getting a lot closer now, and producers still have a big need for liquidity, and we can help. So if we can find a way to buy a midstream asset from a producer at a decent valuation, we can help ourselves and our investors by making a cash flow positive deal for ourselves while buying something from a producer at a valuation that they feel is fair and helping them with liquidity. But that is still difficult. So we're getting busy on the acquisition side, and part of anything we acquire is how do we make this better? How do we add something? How do we connect that next pad for the producer? And how do we build something and get that return for our investors? So that's really where we are. We have a good list of projects on the greenfield side that is just paused. But then we are active today on a couple of acquisitions.
I want to use this opportunity to dive into that point, because a lot of people, our peers in industry, and certainly people look at that, I don't want to work for Exxon anymore. I want to do a startup just like You-won did and like David did, and we're going to do this. And the bid-ask spread is something I don't think a lot of people think about tremendously. So let's dive into what you said, which is, so a producer builds this system that they want to sell. And old midstream multiples, is it fair to say they were like 10 to 12 times cash flow, kind of late 2018, 2019 timeframe? And that would be a trailing cash flow or a forward cash flow?
That would typically be a short-term forward cash flow.
Okay.
It depends, right? That's long haul on the 10 to 12. Gathering has a slightly lower multiple. So you're looking at depending on what it is, from 6 to 10 on gathering systems.
Okay.
And then I think the long haul is exactly where you said it is. So 10 to 12. That's the historic perspective.
So let's go
forward cash flow.
And so that's amazing. So again, for listeners, so think about this. We're going to sell a system at 8 times forward cash flow based on a forward volume projection over the next 5 years that is going to show growth. And then if you followed the hot take of the day for any period of time, you know that when I hear the word growth, I want to punch myself in the face and rip out all my hair. And so you can imagine that a producer who was building this system to sell at 8 times forward cash flow now is finding that not only are their volumes the same, but in most cases, they're probably shrinking. And so they have a shrinking asset that's now crushing their valuation to a 3-4 times multiple, which is where You-won wants to buy the system, is at a 3 to 4. But the producer, if they sell it at a 3 to 4, they probably don't even get their money back. Now, maybe there's an argument, but it's certainly not a 2 or 3 or a 4x return. And in order for companies to make up for the loss in commodity price, they're trying to find places they can make 2 and 3s and 4s. And so you have this bid-ask spread that exists both in midstream, but in upstream E&P, no doubt on the downstream, where no one is actually having a real conversation around this is what you'll produce, which is why I say it will take 2 to 3 years for everything to normalize so that it's a forward-looking cash flow. Do you agree with that? And is there anything else that would be a catalyst to help bridge that gap?
Yeah, I want to say it's the one thing that you've missed before you even get to the multiple is the cash flow, right? So I may have very different cash flow projections from the producer. So the first thing you try to do is get your cash flow forecasts in the same ballpark that you're going to put the multiple on. So a producer that is telling me today, I'm going to pick up a rig at the beginning of 2021, right? My investors may not believe that. So just there on what cash flows we are basing our multiple on, we already have a disconnect. Now, rewind 3 months where people were shutting in production. What cash flow do I use there? So the whole shut-in of production through midstream for a loop completely, because that is not supposed to be happening, right? We tell our investors, and our investors believe this with us, that for midstream asset, it is extremely, extremely unlikely that producers will ever shut in production. And that has been proven true for the last 30, 40 years.
Yeah.
Until 2020, right? So that downside case of producers shutting down cash flow was never on the table. Suddenly it is. Now we have to protect ourselves and our investors against a scenario where we go back to not minus $46, but $20. And we're shutting in production. And now that also brings down the cash flow forecast, which brings down what we can pay producer. Luckily, we're not there anymore, right? Today, we're in a world where at least I can, and the investors and the banks and everybody can feel confident that should be above $30 surely when we invest in this asset. We should be above $35 surely when we invest in this asset. So that's what helped the bid-ask spread come together. And the second thing I just want to confirm that you said, absolutely, producers are looking at selling systems that they are not getting their money back.
Yeah.
If they built in-house a system for a 2-rig program for the next 5 years, they had to put some big pipe in the ground.
Yeah, absolutely.
And now they are not running a single rig program. This thing is only serving PDPs. They don't need that pipe, and I don't need to pay them for that pipe. So it is certainly there are situations where it is a good deal. Everybody get the rationale of the cash flows, but producers are not getting their money back. So it's difficult.
And there's a lot of complications with that too, because not only have now producers built bigger pipe for bigger development plans, and you're trying to find, I mean, so there's so much nuance. Does that sort of bias us to a business model, at least for the next year, where it's you looking at your peer companies and you guys saying, okay, on a relative value basis, under this scenario that we can both agree to, that gas is 225, oil is 40, development plans look like this. On that basis, we look like we would be this cash flow. You guys would be this cash flow. We're going to come together. We're going to rationalize G&A. We're going to strengthen the balance sheet. We're going to make all our investors happy, and we're going to have more, basin access. And I mean, it's so utopian. You're going to get along with another CEO and come up with this perfect relative value metric. But isn't that really where we have to go for the next year, while everyone rationalizes these other thoughts around what growth is going to be?
I think it is, there's 2 core competencies here, right? So the argument for putting these 2 businesses is what you said, right? The uncertainty in the industry and the lack of understanding of where we're going to be a year from now. So that I totally agree with you on that one. The other side is looking for good rock and getting that out of the ground in a cash flow positive way to investors is one skill. Running a 15-year boring old pipeline for 15 years and making sure it doesn't leak is another set of skills. So there's an argument on both sides of that. I do think that the companies like the EOGs is a great example of the people that can do this in-house will always have an advantage because they can, they don't have to look at the same risk-reward trade-offs that I am looking at as an external company, right? EOG goes, I don't really care about this pipe. I need this pipe because I know I'm going to drill eventually. I'm just building this pipe.
Yeah.
And I know they're very disciplined with their capital as well, but they can make certain decisions that a midstream investor cannot. A midstream investor typically will not accept a lot of drill and they will come risk. But what Black Canyon is trying to set ourselves up as is doing something to bring that same technology, at least, to producers that can handle the forecast. The bridge I see DRW at the moment is an earnout structure where we structure a deal with a producer saying, I can only pay you for PDP right now on this cash flows. Maybe if there's some MVC or some very sure assurance, something a little bit above PDP. But generally, let's just simplify it to, I can only pay you for PDP cash flow. But if your dream comes true, your hope that I share with you, that we pick up a rig next year, I can pay you some more. I can give you some more cash on the table to share the upside a little bit. So we see more of that structure going out there but that structure also means the cash the producer is getting today is, in a lot of cases, very disappointing.
Well, I mean, this is a case where hope as the plan is actually the plan.
Yep.
So that works. but it's also, again, but it's reasonable because, one of the things I used to get asked a lot when I would teach courses and talk to people about valuation is they were like, how do you as an upstream producer value the pipe or value the facilities or value the tanks? And I always said I don't. Because in order for me to get the cash flow stream at that assured operating cost, I need to have that infrastructure. And so I'm not really paying as an upstream guy for pipe and I'm paying for NAV. And that's where you can bridge the gap where almost any cash is better than no cash. And if you have a hope as a planned future for growth, you can then both mutually sort of agree to this structure, which seems reasonable and compelling. In terms of the last 6 months, have you been able to get any deals done? And are there certain basins that are more apt to that versus others right now?
I have not in the last 6 months got deals done. One was because 3 months ago, there was a big argument about paying for PDP because we saw shut-ins, right? I still hear that conversation where people want to go PDP, 90% of PDP, because what if you shut in wells again? So that was that bid-ask spread that has been wide. We are today in much better place where we feel pretty good about a shut-in. If it happens again, it'll be short-term, like it was. It was a shut-in situation. It passed really quickly, and we are in good places on multiple conversations on the earn-out type structure. The other thing I want to say, just on the finance nerd side, is risk allocation, right? Investor in a production company tend to accept price risk. Investor in a midstream company tend to accept volume risk. So they are willing to take a lower return because they don't have the direct, immediate price risk. Long term, you still have the price risk because the price risk on midstream comes through the volume risk. So if prices stay low long enough, eventually midstream is going to feel it. But in theory, if we allocate the risk correctly, upstream investors will pay a certain multiple for drilling risk and price risk and volume risk, and midstream investors will pay a higher multiple by paying for less price risk and volume risk. So that's sort of where this should work in a well-functioning capital market, but well, DRW, that's not the case today. There's is all busted at the moment.
And I tie all this together because I think that one of the points you made in there is so key. You have the haves, and I've said, historically, I believe EOG is one of the best run companies, and they have the most appropriate balance sheet for our state, and they use certain instruments at the right time, but they fully integrated the supply chain before really anyone else and have had the most success. And as you said, if they think they need the pipe, they build the pipe. And so you have the haves that are EOG that would be more apt to, if they go and consolidate, they would want to buy someone like yourself to internalize everything. And then you have really what I would call is maybe the have-nots, but certainly more capitally constrained, more reliance on outside partners, less internal skill set and expertise like your company brings to be able to integrate that. It makes for a really interesting balance in the industry. Where do you see it going over the next 3 to 5 years?
I've been following some of what you've been saying in terms of consolidation and the haves. The haves are going to win some battles here in the foreseeable futures. I think you see the bankruptcies coming through the system. You see people coming out of it. Others don't. So I do think the haves in the upstream side will have the opportunity to gobble up more and more. I think in my space on the midstream side, I think there will always be a role for essentially what's happening in my business is I am an outsourced service provider to a producer. So EOG can do it themselves. They do it themselves. Others need to stay lean and mean and focus on what they're really good at and outsource. I do think there is a healthy battle between a company that's really good, a smaller company, not an EOG, a larger family or private equity-backed company that's really good at drilling, which is outsourcing to a company like ours that's really good at what they're doing and have a good capital provider. I think the losses in that outsource model is not as big as you would think. I think that model can still compete if it's well done against the EOG for reasons, like I said, maybe my capital structure is a little bit more efficient because I do put the midstream assets with the midstream investors and the upstream asset with the upstream where EOG is just putting the capital with large. So there's a fight I'm willing to fight.
Yeah.
It's not as clear that, but what I do think is if you have an inefficient small company partnering with an inefficient gas company and another inefficient oil company and another inefficient water company, that is a tough competition to win against a very efficient setup.
Efficient. I think that really, I think, brings the whole conversation to a full cycle, which is efficiency is the way you're going to win go forward, and that when companies like yourself who can bring multiple streams all in the same ditch, helping greenfield developments and then consolidating from a cost structure others, it seems to work. Now, if you were to go back and talk to yourself, let's go 20 years ago. So you can't really include like, hey, just to let you know, the world's going to shut down in 2020. So
But
go all cash in February, but then go back into the market just when you should be terrified. Can't give yourself that advice. But what would you give yourself as a business builder that you think would have accelerated your success, and that was a painful lesson to learn at the time, but that's been instrumental to you now?
Yeah. So the one thing I want to say is what you said before about working for a large company than an entrepreneurial company. Grass is always greener on the other side. Make sure you and your family can handle an environmental or entrepreneurial setup, right? I think you and I both know how long you go without a salary when you start a business, right? So that, don't underestimate that stress on your personal life, right? And I'm lucky I have an angel for a wife, so she stuck through me through all of this. But that is one thing to really think about. There is a lot to be said with dealing with some of the corporate stuff in exchange for stability. So make sure you're in the right family situation before you do this. But on the entrepreneurial side, I think what the hardest lesson I heard, and it hurt me and some of my closest friends, is people. You cannot do enough people diligence. So I am on the financial nerdy side, right? So I am gonna be very, very disappointed with myself if I miss something wrong on the finances. My financial diligence and the diligence about the business has not yet hurt me. I've got that training. That's in my nature. I'm the nerd that will go sit in an Excel spreadsheet till late at night, make sure I understand everything about this deal or this company I'm buying. But where I've made a mistake in the past is I've missed people diligence, where I partnered with somebody and gave that person a significant chunk of my business and control over my future, that when things went badly, instead of fighting next to me, that person left. And that is not on that person, that is on me, because I chose them as a partner. So I want to stress to everybody, if you're an entrepreneur, you are going to take money from investors and you're going to give control of your business to those investors. You are going to bring in a partner on your business and you're going to give control of your future to that partner, right? So especially in Midstream, there isn't a way to raise $50 million or $100 million for a construction project while keeping control of your business. It's just not possible. The majority owner, the guy that brings the cash, will have the ultimate say. So the people diligence is so important. And so, I mean, it's fun to do people business, right? Go play more golf is what I'm telling you. Go on a fishing trip. Go spend, if hunting is your thing, go bow hunting with that partner, right? Because it's really difficult in a normal day-to-day business situation to really see what is somebody going to do when things get really ugly, but that's what sometimes these things are for. You can't talk to enough past partners of somebody. So just watch out for that. It really has hurt me. It has changed the trajectory of at least one business I've been on, where somebody that I chose as a partner didn't behave as I expected. And in the end, you cannot blame anybody else. When you are CEO, everything is on you. Everything is on you. Can't even blame your board because you chose those investors, right? It's all on you. And so all the people diligence is on you. So that I cannot stress that enough. I think you can hear how passionate I am about it. It is really, really, really important to not let, a lot of us are engineers or financial nerds, get out of that box. You have the people diligence is what everything is about.
I think of all the times I've asked that question, I mean, everyone has a very unique answer. This one resonates the most with me because it's obviously happened, and I say that all the time. you would never marry someone after 2 dates. You need to spend time. And so, quite frankly, everyone I have hired over the last 8 years has been someone I had worked with before, spent years with, was friends with. And the test I always used was, is this a team member that you could be trapped in an elevator for 2 hours with, and that it's like your whole core team, and that you guys leave that elevator having had an entertaining, if not stressful experience, and that no one is like, wow, I really dislike that guy. So I think that is a great place to leave it. I want all listeners to rewind to listen to that again. If it didn't quite sink in, it is probably the best piece of advice we've had on the show. So You-won Themaat, I really appreciate you coming on. We're going to come up with a 3-handle or a 6-letter handle for you. So it'll be DRW and JT.
You could just do JT.
JT. Well, I love it. Thanks so much
for joining us. And until next time, subscribe if you like what we're doing. Send me an email at drw@hottakeoftheday.com. Until next time, be safe, be good, have a great day.